Hello everyone, welcome to another session. Today we are going to talk about accounting for bonds. So first let me tell you what is the definition of bonds, and then we will talk about how to calculate the cash proceed from the bonds. I mean to say issue price, and how to record initially the bonds in the statement of financial position. So here we have a definition. Actually bond is a formal contract to pay an amount of face value at maturity date plus interest at stated rate at specific interval. So let's have a look. Let's understand first what these words are there. So face value mean to say it is also called par value. It is also called nominal value, which is mentioned on the face of the bond. So then there is a maturity period. Maturity period mean to say maturity date mean to say it is the date when the company will redeem or company will pay back your cash back to the investors. Okay, that is called maturity date. It could be 5 years or 10 years. Okay, if company is going to repay your money after 10 years, what company will do? Company will pay interest at stated rate at specific interval. Stated rate mean to say it is the rate of interest which is mentioned on the bond. It is also called coupon rate. Specific intervals, I mean to say the interest would be paid half yearly or annually. So the what is the bond indenture? Bond indenture, actually it is a document where all the terms and conditions are stated. That is called bond indenture. As I told you, coupon rate or stated rate is the rate of interest which is mentioned on the bonds. Then duration of the bond is also called maturity period. Interest is paid at stated rate. It could be, as I told you, half yearly or annually. So bonds might be secured or unsecured. Secured mean to say sometimes bonds are secured against the real estate assets. If bonds are secured against real estate assets, so that is called mortgage bonds. There is another word which is called debentures. Debentures are backed by only by the borrower's general credit. General credit meant to say, as an investor, if you are going to buy the bonds of any XYZ company, so you just might have a faith on the company that he will return your money back, but there is no specific collateral. So here you need to remember the difference. In US, unsecured bonds are called debentures. Like debentures are not secured, but in British studies, the bonds or debenture might be secured against certain assets. Then we have another word which is called collateral trust bonds. Collateral trust bonds are backed by specific securities. Maybe these bonds are backed or secured by certain other securities. Maybe you might have a certain stocks or certain other bonds as a security. Like in case of default, as a lender you have an option to sell those specific securities. So then you have a guarantee bonds. It is also a secured. Guarantee bonds are guaranteed by a third party. For example, the parent of the subsidiary that issue the bonds. Maybe subsidiary is going to issue the bonds, but parent company is going to give the guarantee on behalf of subsidiary. That is what that is called guarantee bonds. Then here you should remember few notes. It's really important. We will always calculate the interest on the face value, which is also called nominal value or par value. So for example, if you want to calculate the amount of interest, what we will do, we will take number of bonds times face value per bond. This will give you total face value times stated rate. Stated rate means to say the rate which is mentioned on the bonds. So here we have a small example just to calculate the amount of interest. For example, company issues 10% 6 years 200 bonds with the face value of 1000 each. Here actually the 10% is the stated rate. 6 year is the maturity period. 200 bonds are the number of bonds and face value for each is 1000. So interest is payable annually. So if interest is payable annually, so how we can calculate the interest? So simply what we will do, we need total face value multiplied by interest percentage. So to calculate the total face value, you have to apply this formula: number of bonds multiplied by face value per bond. And here number of bonds are 200 and face value per bond is 1000, and rate of interest which is stated on the bonds is 10%. So this is how you will get the total interest value. You should also remember, for issuers, I mean, say the company is going to issue the bonds are always liability. Okay, and for investors, bonds are always investments or assets. So we are going to talk about bonds payable initial measurement for the issuers. Okay, issuer mean to say the company which is going to issue, how he will measure the bonds initially. So you should remember here, Bonds could be issued at par, it could be issued at discount or at premium. So how you will decide, do we need to issue the bonds at par, premium or discount? So what we will do, simply at the date of issue, we will compare the stated rate which is mentioned on the bonds with the market rate or effective rate which is prevailing in the market at the date of issue. So here we go. If our stated rate is equal to market rate, for example stated rate is 10%, market rate is also 10% at the date of issue, so we will sell the bonds at par, okay, at face value we will issue. So if our stated rate is 10%, which is less than market rate, so we will sell the bonds at discount. Why? Because we are going to pay the interest less than market rate, so that is why today we should receive less money than face, that is why it should be issued at discount. So third scenario is if your stated rate is greater than market rate or effective rate, so bonds should be sold at premium. The reason is that we are paying higher interest than market rate, so that is why today we should receive more money. So this is what is the idea behind, to take a quick decision how to sell the bonds at par or discount or premium. So the question is that, amount of premium or discount, if you want to calculate the amount of premium or discount, so how can we calculate? So it is a simple idea. What we need to do at the date of issuance of the bonds, we need to calculate the present value of cash flows associated with the bonds discounted at interest rate prevailing in the market at that time, okay, at the time of issuance. So the market rate, as I told you, it's also called effective rate. So in short, we need to simply calculate the present value of two things. We need to calculate the present value of face amount, okay, and we also need to calculate the present value of periodic interest payments. So simply what we will do, we will convert back this face value and interest payments. We will calculate the present values of these two things, okay, and then we will compare the present value of face value and interest payments. We will compare with the total face value, and we can calculate the amount of premium or discount. So here we go. Here we have a small format. So if you want to calculate the amount of premium or discount, first we will calculate the present value of what, face value of the bonds, okay. You will take the face value, multiply by present value factor at market rate. Don't make mistake here. What students, they can make common mistake, they can select the discount factor at stated rate. No, we have to select at market rate, okay, because market rate is our benchmark. We are comparing our bonds with the market to calculate the amount of premium or discount, okay. So then what you need to do, you need to take a interest amount per annum. I have already told you how to calculate the interest will be calculated always on the face value. We will multiply with the annuity factor at market rate. So here you have a two words. Here is the present value factor at market rate, and here is the annuity factor at market rate. So actually you can look these two values from these two tables. If you want to look for present value factor at market rate, simply you will go to the table. I am assuming you have idea about the present value and the time value of money. So but if even you don't have idea, so simply you can select these present value factor from this table. Like if I want to select present value factor, I will use present value of $1 table. So here we go. Let me show you how you will select. So here we have a present value table. For example, here we have a present value of $1 table. I hope you can view it, okay. For example, if market rate, market interest rate is 10%, this is the percentage is mentioned here, 10%, okay. Like here is 1 2 3 4 5 till 20%. You might have any other percentage also. So for example, you will go to the 10%, and here you can see the vertically periods are mentioned: 1 2 3 4 5 6 7 8 9. Maybe if I want to select for 5 years at 10%, I will go to the 5 year row, 5 years row. For example, here we have 5 years row, and I'm moving to the 10%, and here we have 10%. So it means for 5 years we have here a 0.621. This is what is called present value factor, okay. So now here let's discuss about other things. If you want to calculate the interest present value of interest amount per annum, because interest amounts are constant, so we can use here annuity factor to calculate the quickly present value. So what we need to do, we will multiply interest with the annuity factor at market rate. And annuity factor you can select from this table. This table is having the name of present value of ordinary annuity. So let me show you the table also, if I hope it is visible. So here we have a present value of ordinary annuity. Here is the annuity table you can look at here. Again, if you want to select any factor, what we will do, we will go to the percentage. For example, here now percentage is 5%, and I want to look for 2 years only. For example, 5%, and this is the year 2. I will move to this value. It is 1.859. You can look at here. This is what is the annuity factor. So once you will get the present value, okay, of the face and of the interest amount per annum, just we will make the summation of these two values. This is called your total present values. It is also called your issue price. It is also called your market value. It is also called your cash proceeds. Okay, so you will compare this present value with the total face value. If now you will face value of course will be given. Now there could be a 2 or 3 maximum scenario. Scenario number one is what, maybe your total present value might be greater than face value, so it means the difference is called premium. Second, what if your total present value is less than face value, the difference is called discount. And third scenario is what, if your present value is equal to the face value, of course it should be issued at face value. So now here just quick entries, then we will practice. So if scenario number one, if your total present values are greater than face value, it means bonds should be sold at premium. So what entry you will pass at the time of issuance, you will make debit cash with the total present value, credit bonds with the face value, and credit will go to premium on bonds payable with the difference of present and face, or you can calculate the difference above. Okay, as we have learned there in the format. So the second scenario, if your present values are less than total face value, it is called discount. For the discount, how you will record the bonds initially, you will make debit cash with the present value, credit bonds with the face value. Now the difference will come on debit side, so that is called debit discounts, discount on bonds payable. Okay, so but if your present values is equal to face value, so bond should be sold at par. So here what entry you will pass, debit will go to cash. Okay, because here your total present value will be equal to the face, so and credit will go to the bonds with the face value. This is what is the entry. Now let's do a small question to understand, and there are certain other alternative ways also to calculate the amount of premium or discount that I will show you at the end of the video. So here we have a small example. For example, ABC company is planning to issue 10% 6-year 200 bonds with the face value of 1000 each. Interest is payable annually and market rate is 12%. So here first of all, simply calculate the value of interest. How you can calculate the interest? So I'm going to calculate interest for one bonds. What I will do, I will take face value of one bond, which is 1000, multiply by stated rate, not the market rate, stated rate, which is 10%. This is how I will get the amount of interest. And you can look at here, your stated rate is 10%. Your stated rate is 10% and market rate is 12%. It means when our stated rate is less than market rate, so bond should be sold at discount. So it means this is the case of discount. So you will get the discount value. How you will calculate the discount value? Simply you will take here, I'm going to calculate present value of one bond. At the end, I will multiply with the number of bonds to calculate the total value. So here we go, the calculation for one bond. So what I will do, I need to calculate the present value of face value, which is 1000. And I also need to calculate the present value of interest per annum, okay, which is $100 we have calculated here. Okay, so we will multiply the face value, we will multiply with the PV factor, present value factor at market rate, and market rate is 12%. Don't forget. Okay, just what you will do, go to the present value of $1 table. Okay, and check the column for 12% for 6 years. So you will find this value there, 0.507. Okay, now once I will multiply this face value, which is 1000, with this present value factor, which is 0.507, I will get the present value of face. Okay, so then I have to calculate present value of interest per annum, which is $100, multiplied by annuity factor. This annuity factor, you have to look into the table of ordinary annuity. Go to the 12%, look for the 6 years, you will find this value there, 4.111. If I will multiply 4.111 with the interest per annum, which is $100, so I will get the present value of interest. So if I will make the summation of face plus interest, I will get total present value, which is called total cash proceed for one bonds. Okay, so I will compare this with the face value, and face value of the one bond is 1000, and present value is $918.10. So the difference you can look at here, your present values are less than face. It means this is the amount of discount. So the amount of discount is 81.9. So now if you want to convert your calculation into total, what you can do, if I want to calculate total present value, what I need to do, I will take present value of one bond multiplied by number of bonds. And you remember the present value of one bond is 9.918.10. You will multiply with the number of bonds are 200. This is total present value of bonds. Okay, then you have a total face value. How again I can calculate face value of one bond, which is 1000, times number of bonds, which is 200. It will give me total face value. So this is how the difference of present values and total face value is the total discount. Okay, this is the amount of total discount. Now what entry you will pass? So because our present values are less than face value, it means it's a case of discount. So what you need to do, you will make debit cash with the total present value. Okay, debit discount with the amount of discount you have calculated here, and credit will go to bonds payable with the face value, which is 200,000. You should remember here, sometime in exam, this is really important note, what examiner can do with you. Maybe examiner, he will tell you this way: sometimes the issue price is an exact percentage of the face amount. For example, maybe examiner will tell you this way: he will tell you the bonds issued at 101. It means you are going to issue the bonds at 101% of the face. Okay, so here what how you will calculate the amount of premium or discount. So you will take, if face value is 1000, I'm assuming, and it is issued at 101%. So what I need to do, I can calculate the issue price by taking face value, which is 1000, multiplied by 101%, which is the issue price. So total I will get in dollar, which is 1010 dollars. So now if I want to calculate the amount of premium, how I can calculate? I will take issue price minus face value. Issue price is $1010 and face value is $1000. It means amount of premium is $10 for each bonds. Okay, then sometimes there is another note here: if bonds issued at 99, okay, for example, it means you are going to issue the bonds at 99% of the face amount. Okay, so here what you will do here, if for example face value is $1000 issued at 99%, so this is how I can calculate the issue price. I will take face value, which is $1000, times 99%. Okay, it means issue price should be $990. Okay, so if I want to calculate the amount of discount now, of course, because you have issued the bonds at less than face, because it's 99%, so there is amount of discount. So how I will calculate the amount of discount? I will take face value minus issue price. Okay, here face value is 1000, issue price is 990, so there is a amount of discount is $10. So this is how you will measure initially the bonds in balance sheet, I mean say at the time of issuance. What you will do at reporting date, I will cover in upcoming sections. Okay, So I hope you are clear with this concept, how to record the bonds initially. And if you really like the video, please don't forget to subscribe to the channel. See you in the next video. Thank you so much. Bye bye.